Chewy beat profit expectations by a mile this quarter. I mean, they absolutely crushed it. But the stock still stumbled because the company is warning that we might, well, finally be pulling back on spoiling our pets.
Right, it's the classic guidance trap. You look backward and see 23 cents a share in earnings on, let me check, 3.36 billion in revenue, which is up over 7% year over year. But then management opens their mouths and the narrative shifts entirely.
Which makes this a perfect episode of Earnings Unscripted. Today is June 10th, 2026, and we're digging into the online pet giant Chewy, ticker CHWY, looking at their first quarter 2026 results.
I mean, going into the print, the quarter itself was pretty rough. The stock fell almost 12% over the period to close at $25.54. But the earnings day action was, honestly, it was completely bipolar.
Okay, so tell me what happened with that, because I saw a huge spike in the pre-market. And real quick before you do, just a friendly reminder that this is not financial advice. We're just sharing personal opinions here, so please don't go trade your dog's college fund on our banter. But seriously, what happened with that spike?
Well, they caught this massive early bid, pushing the shares all the way up to $22.33. But literally, the minute the earnings call began at 8 a.m. Eastern, the bottom fell out.
Oh, wow.
Yeah, all that momentum completely reversed. The stock closed the after-hours session just under $20. It was roughly a 6.8% drop from the exact moment the executives started talking.
Jeez, you literally don't see it track that closely to the actual voice of the CEO very often. What exactly did they say to spook everyone so badly?
They downgraded the full-year revenue outlook. Management basically cited a more challenged consumer environment and said people are pulling back on premiumization. So instead of buying the absolute most expensive food, shoppers are getting, a little more defensive.
I mean, that makes sense. It's funny, though, because on the call, management mentioned that the average pet parent tries up to 12 different treat brands a year.
That's a lot of treats.
Right? It's purely a discretionary impulse buy, but people get highly emotional about it. But I guess if the macro squeeze is tight enough, even the dogs have to tighten their collars.
I guess so. And what's fascinating is how Chewy is buffering against that. Because even with the consumer getting squeezed, their Autoship customer sales are still growing. They hit $2.83 billion, up about 10.5% year over year.
Okay, wait, that's a massive number. How much of their total sales is that?
It's roughly 84%, up. Actually, 84.4% of their entire revenue is now locked in on automatic recurring shipments.
Wow. Yeah, it basically puts a giant safety net under the business while they figure out all the weird strategic stuff they're doing, like apparently tripling their physical vet clinic footprint overnight. All right, let's get into the details on that cash flow.
Yeah, so the cash balance drop is actually pretty staggering. They burned through, or rather they allocated, nearly 44% of their cash in just 3 months.
Okay, that is a massive chunk of liquidity.
Right. They went from about $860 million in Q4 down to just under $485 million. And it is not from operations failing or something. It is really driven by two main outflows. $174.8 million went into business acquisitions, primarily swallowing up that modern animal clinic network. And then exactly $200 million went straight into share repurchases.
Which is a choice. You buy back stock with your cash while actively telling the market the consumer environment is getting tougher.
Exactly. It sends a bit of a mixed signal. But the bigger shift, the really fascinating part to me, is how they refilled that hole. Because historically, Chewy operates highly deleveraged. They just run on their own free cash flow. But right after Q1, they launched a $600 million term loan B.
Wait, so they are actually taking on real debt now?
First time. Management called it adding financial flexibility, but to me, it looks like they drained their liquidity for M&A and buybacks and suddenly realized they needed a buffer if things get tight.
Okay, but let me push on that M&A piece because this is where I get confused.
Sure.
Chewy is an e-commerce giant. They operate on software margins and highly scalable warehouses. Why on earth are they suddenly spending almost $175 million to run brick-and-mortar vet clinics? I think they said they're jumping from 18 to 47 clinics overnight. That sounds like a capital expenditure nightmare.
It does sound like a total distraction, and management actually admitted the clinics will act as a modest margin rate drag this year, but here's the insight from the earnings call that makes the math work. The clinics are essentially customer acquisition funnels.
Oh, so you go in for a checkup and leave with a digital Autoship subscription.
Exactly, and it works beautifully. There is a quote from the Q&A session. I am reading this directly. They said approximately 40% of CVC customers, meaning Chewy Vet Care, 40% are new to Chewy.
Oh, whoa, I would not have guessed it was that high.
It gets better. The quote goes on to say, these customers tend to reach a year-one net sales per active customer of approximately $900.
900. Oh, sorry, wait, $900? Because we just established their average customer spends, what, just under $600?
$597, yes.
Okay, so the clinic strategy is basically finding the highest value pet parents offline and trapping them in the ecosystem. I mean, treating them very well in the ecosystem.
Right, trapping them with radical compassion. But honestly, it proves the thesis that physical vet clinics are acting as highly effective, low cost of acquisition billboards for their core retail business. You absorb a little margin drag on the physical side to acquire a total whale of a digital customer.
It is clever. It really is. It takes that intense emotional attachment people have to their pets when they are sitting right there in the exam room and monetizes it across the rest of the year.
Right, but the lingering question is scale. Because right now we're talking about 47 clinics. They expect to exit the year with 60. Can they build physical clinics fast enough to actually move the needle on a $13 billion top line? Modern Animal is only expected to contribute about $70 million in revenue this year.
Which is barely a rounding error for them.
Exactly. It is seed planting, and it takes cash.
All right, well, if they're spending capital like that to plant seeds while everyday consumers are tightening their belts, we probably need to talk about how all of this is going to impact the back half of their year.
Well, management basically answered that for us. They actively downgraded the full-year revenue outlook, pulling it down to a range of $13.4 to $13.55 billion.
Which, I mean, that makes perfect sense. If you are already seeing pressure on premium items, you cannot just assume shoppers will suddenly start splashing out on high-end treats again next quarter.
Right. I actually pulled the exact phrase from the transcript because it caught my ear. They said, quote, "We no longer believe it is prudent to embed a meaningful acceleration in consumer spending into our outlook," which is just, it is remarkably blunt for an earnings call.
That is, yeah, actually, I respect the honesty. Most of the time, executives just blame, I don't know, currency headwinds or some weird calendar shift.
Exactly. But it also means the near term is looking pretty rocky. For Q2 specifically, they're projecting gross margins to actually contract year over year. They're lapping a previous one-time pricing benefit, and those mid-single-digit fuel surcharges are just, they're really dragging on profitability right now.
Okay, so you have slowing top-line growth and shrinking margins. Does that finally open the door for Amazon? Because analysts were definitely grilling them on the call about Amazon pushing so hard into same-day delivery.
They were, but management completely brushed it off. They insisted their brand-specific search volume is totally healthy. But look, competitive delivery speed is absolutely the battleground we need to watch moving forward.
Oh, totally. Because loyalty is a beautiful concept, but if I run out of kibble at 7 p.m. and the dog is staring at me, I am taking the fastest shipping option. Period.
Fair point. So zooming out, the whole story right now is a company bracing for a macro slowdown. They're using that massive Autoship revenue as a shock absorber while borrowing cash to quietly build a physical vet empire. It is a very deliberate pivot.
A pivot into the offline world. Well, let us hope the real estate pays off for them. All right, I think we have covered the key pieces here. Thanks for breaking this down with me, Muriel.
Always fun. Thanks for tuning in, everyone.
If you want these earnings drops to just show up automatically, go ahead and follow the podcast. And as a quick aside, we are an AI-generated show built to make heavy data listenable, but every single metric we debate is pulled straight from official filings. We'd love to hear from you, so if there's a ticker you want us to unpack, email us at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out with us.
Catch you next time.